Kahneman's findings are clear. In good moods, people are more optimistic, more confident, and more likely to engage in intuitive reasoning. People in bad moods are more cautious, more analytical, and more likely to second guess. This has real implications for finance. A fund manager in a good mood is more likely to overweight recent winners, underestimate downside risk, and trust their own gut feeling over models. A fund manager, however, in a bad mood might delay decisions, default to pessimistic assumptions, or overfit risk even when they're not warranted. None of this is framed as emotional in the moment, especially in professional settings. They're just processed as rational judgment. That's what makes it dangerous. Kahneman's research showed that people in a more positive affective state tend to rely more on system 1 thinking, which is fast, intuitive, error prone, whereas those in a negative mood activate system 2 more often, engaging in effortful analysis. During bull markets, when investor mood is broadly high and good, confidence levels spike disproportionately to the actual risk environment. Risk models are usually ignored, underwriting becomes loose, and pricing detached from fundamentals, especially when we do valuations via DCF. None of this is random. It's behaviorable, it's structured, it's mood-distorted cognition masquerading as expertise. Basically, in the most simplest terms, mood reframes our judgment in financial settings, even though we would like it to not be true. Availability heuristic is one of the most fundamental cognitive shortcuts Kahneman has ever documented. The core idea, the easier something that is to recall, the more important or likely it feels to the decision. This sounds benign, but in finance, especially finance compared to any other field, is lethal. The human brain doesn't estimate probabilities by calculating base rates or running down formulas. It estimates based on what examples come to mind most easily. In practice, if a major market crash just happened, investors suddenly believe that crashes are far more likely, even though probabilities of another crash haven't changed just yet. If IPOs are dominating the headlines, investors assume that the IPO market is booming, even if the average return post-IPO is poor. For another point, if inflation is being talked about constantly, people overestimate both its prevalence and its persistence. They may just go into forums or places where inflation is a hot topic. The availability heuristic becomes especially toxic when combined with media. The more vivid or emotional an event is, the more easily it's remembered, and thus the more heavily it weighs in on future decisions. Basically, we overweight or underweight things based on how easy it is to recall in our minds, not necessarily whether these elements actually affect the decision that we have at hand. This isn't some sort of abstract theory. The 2008 financial crisis was followed by a multi-year period where investors underallocated to equities due to the emotional pain of the crash, even as fundamentals improved, especially in the post-crash 2009 to 2012, and equity valuations for most companies actually remained attractive. They didn't forget the crash because the pain of the memory was available, and because it was available, it felt predictive even when it wasn't. What Kahneman shows is that ease of recall is mistaken as evidence. This contaminates every aspect of financial reasoning, from risk assessment to asset allocation. Let's now change topics again and focus on the law of small numbers. It's not a statistical principle, it's a sort of cognitive error. People believe that the small samples reflect the characteristics of the larger population. In simple terms, we see patterns where none exist and draw big conclusions from small, tiny datasets. The problem is everywhere in finance. For example, a hedge fund delivers strong returns for just 3 quarters, and investors treat it as evidence of skill, ignoring the fact that you need better datasets in order to know that this wasn't a fluke. 3 quarters is just 9 months. Or even then, an investor may just pick 10 stocks out of the blue, see 7 of those stocks have good returns and assume it's reliable. It's not. It's sampling error dressed up as signal, because the amount of trades on the stocks picked inside of the basket is too small. This illusion is magnified by randomness. In a sufficiently large dataset, some small samples will produce extreme outcomes just by chance, but human intuition resists this. System 1 sees a hot streak and assigns it meaning. System 2 should correct for it by referencing base rates or confidence intervals, but rarely does, especially under time pressure where most finance decisions are made. The law of small numbers also drives excessive beliefs in anecdotes. When an investor hears about one successful real estate flip or one angel investment returning 100 times and assumes that the strategy is replicable, it creates a rush in investment, even though the result was a one-off. It's a type of narrative overfitting. The brain cannot produce that many outcomes. It's a type of narrative overfitting. We see an investment that is good on the surface and then it doesn't happen for us. The brain cannot accept that outcomes may be random, so it constructs causality from the data. Even entire sectors become mispriced. This is actually fundamentally why we see fundamental overvaluation or undervaluation. When entire sectors become mispriced because of a few early examples are taken as representative. For instance, we see AI stocks doing suddenly very well. There's a bubble. A handful of crypto projects make outsized gains. Suddenly, the whole asset class of crypto is treated as revolutionary, even though most cryptos fail. Kahneman's insight is brutal but necessary. The brain assumes the world is more predictable than it is. It assumes that cause and effect can be found quickly, especially in noise. And when reality resists that narrative, we force meaning into the data anyway, making us very prone to bad trades.